2014, and here is my weekend review. As always, I put a title that sort of defines or describes my thoughts of the market, and basically, as I heard also from Gil Morales on his webinar today, that we had a bull trap this week, and my question is there a bear on the horizon? And as you can see the little picture, I think I see him. There's my email. If you'd like to contact me for any reason, feel free to email me at your convenience. As always, this is for educational purposes only. Any recommendations are in the spirit of education, not investment advice. I'm a doctor, not a broker. As I joke, but it's no joke, most physicians lose money with their investments, and I'm not affiliated with any software vendor or trading company. The tools I demonstrate and the ones that I use are the ones that I use in my daily trading, and I have paid for all these tools. I'm not going to spend as much time as I sometimes do on this, but the point here is that you have to identify as individual investors who you want to learn from, who are your so-called gurus, who are meaningful to you. And on this form, on this page, are a number of people that mean a lot to me: Ian Woodward and Ron Brown of Woodward and Brown Investing, O'Neill, Morales and Katcha, Jesse Stein, Mark Minervini, Van Tharp, Bigelow, and others, Alexander Elder, are all folks whose books I've read, some of their live meetings I've attended, websites I use, and together they've helped to shape the trader that I've become. So in the words of Ian Woodward, I'm not a guru. I hope to teach you to become your own guru, and you need to use a lot of resources to build you out the way that you want to be. I have a lot of different programs on my desktop. I purposely hide it, but I have to have a real-time trading platform. I use TradeStation or Thinkorswim. I've customized both and can pretty much interchange. There are certain reasons, such as radar screen, that I favor TradeStation. Thinkorswim had a big update this weekend. Hopefully they updated their servers. We'll find that out when the market opens Monday, when a lot of us have had issues with the Market Watch function. I need something to analyze stocks with. There's nothing better than HGSI, including, even though I have the other two programs, I use EdgeRater and ETF Bandit, seasonal analysis with Magenta Trader, and MarketSmith, often to supplement my analysis with HGSI. I always like to talk about this because you've got to know where you are. And we've been stuck where this red circle is, and I mean stuck because every time I think the market's rolling over, we get another leg up. And all markets and all time frames repeat this pattern of ambivalence, greed, uncertainty, and fear, and start all over again. In fact, if you look at just a daily, a minute chart on a day, almost any instrument, you'll see this pattern repeated over and over again. My thought is that we're going to break to the downside this time. Each time that I've been concerned about that, we went to a new leg up. I think at some point we're going to pay the piper, and it feels like that time is near. Again, apropos, considering the market that we're in, don't fight the trend. It's easy to go up, to go long in a long uptrend. You want to buy pullbacks. You can set your stops right below the pullback. But reality, on a strong bull that we've had since really almost continuously in the last 13, 14 months or longer, it didn't matter where I bought. If we go into a bear, it's really hard to be long in a bear. What you want to do is be shorting retracements. But it's very difficult to see a time that you could have gone long on that chart to the right and made money. We're supposed to spend most of our time in a Darvas box or sideways market. We don't seem to have many of those of late. Maybe it's because of QE and news. But in this type of a sideways market, you want to sell resistance and buy support and look for breakouts and breakdowns. Now, this is an important slide that I took from Ian's deck. Now, this is based on old data, and I'm currently redoing this using some of the data that I have in defining markets, whether they're strong, up, mixed, strong or a weak market. And then, but what this represents is every month there was a meeting in PV over the years. And this is 15 months worth of data. And you'd have the same smart people led by Ian at each of these meetings picking stocks. So it was the same people, and these are smart people picking stocks the same way. and then they characterized the results retrospectively. Prospectively picked, results were looked at retrospectively, and they looked at results based upon type of market. There's a lot to learn here, and as it says, it speaks volumes. In a strong market, they did extremely well, 106% up after 4 weeks of trading, 20 days, 78% after 40 days. In a weak market, the same people that had over 100% performance over 20 days, they actually lost 32%. In a mixed week, they lost 50. So the first thing to point out is that in growth stocks, high growth stock investing, it matters. And that what matters is that you need to make sure that you are buying when the market is strong, and that when the market is not strong, it's very difficult for somebody to make money going long. The other thing that I see here that's important is that you get most of your benefit early on. As you can see, this makes an argument against long-term hold. Now, I don't think that this necessarily applies to the market that we've had since November of 2012, where some of the best returns have been people went away. But it does point out in a more typical marketplace that you buy something breaking out, you get your return, and the longer you hold it, the more the return goes back to reversion to the mean. And that's something I'm looking at. I'm analyzing IBD 100, IBD 50, my buy list, and a couple of other lists that I track, and looking at how it compared over week to week, over 20 days, over 40 days. And I'm just working on defining how to characterize the market. So we just got back from an outstanding meeting, as usual, in Palos Verdes. There may be another one in October. Unfortunately, I'll be in Australia, or not unfortunately. And hopefully you guys will get to experience some of the great things that I've learned over the years. But as you go through this period of a cyclical market, what Ian and Ron and others have come up with, myself included, are a series of indicators that help you to understand where you are on that ambivalence, fear, and greed cycle, and to help you make the right choices based upon the cycle that the market is in. Now, you notice in the upper right-hand corner, it looks like a dead canary. Well, I think last week I said the canaries were on their last gasp. I think he died. You can get great pictures on the internet. It's so much fun. But unfortunately for that canary, and for anybody that had a portfolio made up of the canaries, you could see it's been dying, and it's coming down close to the 200-day moving average. That's a pretty major drop, major drop. We'll quantify things later. You can see that the Bongo Weekly has gone red, the daily, the forces are red. You had a mobile breakdown again on Friday. Just an awful chart, and you know this because you probably own some of these or did own some of these. The leaders of 8 months ago, major run up, and they came down hard. Now, a better representation for me has been the October LLUR list, which are stocks that we picked at the October PV meeting, and they too have broken down. Now, you'll notice you still have a PSAR buy signal underneath these stocks. So it'll be interesting to see if they bounce from here. But they too have got red Bongo Weeklies. Everywhere across is red. A mobile breakdown out of a squeeze, a big kahuna down. This red line here is a phoenix, which just tells you the softness of the market itself. So it's done its job. It's told us that this market is broken or is about to break, and it's time to run to the hills or to take profits. Secret list to the left are the list of stocks that we put into the new LLUR list. Now, again, the point of an LLUR list or a leader list is to put together a list of the stocks that have outperformed with the hypothesis the stocks that had the biggest moves up will be the ones that are the last, or the first to fall when the market starts to correct, and they can give you an early warning signal. We pick stocks that characteristically look like this chart of starting in the lower left and running up to the upper right. All of them were extended. All of them were leaders. And you could see just on Thursday and Friday how much they fell. You had a PSAR flip on Friday, and you started to get bongos to the downside and force to the downside. So already rolling over is not a good sign, and part of why I think that this market is about done with going up. So market themes, momentum stocks were pounded for another week. Classic bull trap, I'll show you what that looks like on Thursday and Friday, Thursday at least. High beta stocks are falling like rocks. There's clearly a shift to defensive stocks. Food, energy, those that give yield. Speaking of yield, dividend payers are leading REITs, MLPs, utilities, bond funds. Big caps are joining the party. Now, it's not a happy party because they're putting on the black hat and they're falling down as well. And markets that are at high risk here and maybe in the process of rolling over into the land of the bear. So again, last week, continue to get rid of positions, raising cash. I'm out of margin. I added to my contras. And what I did on some of my long-term positions is I bought some Mary puts. They were deep in the money, and I'm just not ready to sell them from a tax perspective, but I wanted to lock in gains. And what I can do about them is I can sell calls and puts against my existing position. So not only have I limited my downside for a very modest premium, but I also have an opportunity to generate some income against them through premiums. HGSI Summer Retreat, here's the first notice. Contact me if you're interested. I'll give you more price. I'm still working on it. Depends on whether I include meals or not. I have a couple meetings this week with hotels to figure that out. It'll be in West Palm Beach, Florida. It'll be designed for people who have some investing experience but want to become a power user of HGSI. The content for HGSI will be at the advanced newbie range. What that means is I'll give you the definitions before we get there and everything else we're going to learn together. It'll be HGSI Unleashed. We'll talk about EdgeRate and other tools, including Magenta as adjunct to HGSI. I'll show you how I do top-down investing with HGSI, my favorite tools, bottoms-up stock picking, a lot about stocks versus options, and money management. My guess is it'll be $600 to $800 for the base, another $250 if you want my TradeStation indicators. It all depends on where we go and whether I provide meals. And if you're interested, email me. That's the date, and I'll get you more particulars. I should have the price figured out by the end of this week. So now let's go off to the charts. I'm going to stop the tape for a second, and then we'll get started. So as always, I like to start with and do a review of what the market was last week. And it was pretty impressive in a lot of different ways. As you can see, I started on Saturday, could have been Friday, and the day it's the same thing, and looked at the ending date this Saturday. So this is a one-week move. I looked at the closing price on Saturday, closing price on Saturday. So close to close. So Friday close to Friday close. First thing I look at is the amount of black, which are up, to red, which is down. So you could see that for the week it was mostly down, but there were a lot of positive groups. Now the S&P 500 through this weighting, and this is a equal dollar weighting using an investment of $1,000. The S&P 500 was down 0.39%. So for the week, the S&P 500 was flat. Now, interestingly, the HGS 100, of which there weren't even 100 stocks in. No reason for it to be here twice, so let me just take that one out. Which just tells you how weak the market was actually up 0.21%. My stocks in uptrend were up a little bit as well. Top 100 Vector Best was up 0.74. Mobile breakout squeeze from TradeStation were up 0.92. Top 5 for my smart groups, mobile breakouts, Kapuna Force mobile breakouts. So a lot of stocks that were breaking out or had breakout patterns last week were up. Here's some of the most impressive. These are the M&K, these are the smart group from HGSI last week, and you could see that from 1 week, if you had bought the 10 stocks that had viable gap ups end of day Friday and bought them at the end of day Friday and sold them end of day Friday this week, you're up 10.38%, 9 out of 10 winners. If you combine Kapuna Force, mobile breakouts, viable gap ups, and pocket pivots, I had 9 of them last week. They were up 6.48%. If you bought Best of Woodward or Brown, you're up 5.5%. Look at stocks and groups to the upside, 4.43% on the small ones, 2.22 on the big ones, strong EPS near 52-week high. So you could have made a lot of money buying the stocks that were the leading groups and that broke out a week ago. Now, interestingly, the IBD 50 was down 2.26. This is really not an accurate reflection of anything since I've got protection in and I've sold out most of the things that I don't have protection in. But if I'd left my holdings alone, they would have been down 1.66. It's a pretty big if I had left them alone. I don't intentionally leave them alone often. I'm just looking for one of my groups that I don't see here. The Canaries were down 2.38, IBD 50 down 2.26. Here's what's just amazing. Woodward and Brown groups and stocks to the downside, 7.83 of 100 stocks that made it to the list. This was a week tape. 98% of them fell. 88% fell of the 1 to 15. And look at the returns, over 7% had you just shorted that list. Those stocks with supply were down 5%. Here's one of my meta stock searches that I do every week. Blue Sky breakdown, 75 out of 75 were down. I don't think I've ever seen anything be 100% like that with that many stocks down 5%. So you really had an interesting week where things that broke out on Friday last week actually held up pretty strong, Bible gap ups and pocket pivots and the leading stocks. But as a whole, the market got trashed. Now, I looked at it from multiple days. If we look at Friday, market to close, open to close on Friday, you can see that except for green candle lows, which on a bad tape, look at that, 8 out of 8 were up 1.5%. Kahuna Forest Mobile Breakout Pocket Pivots were up a little bit, but not much. Pullbacks in an uptrend, 13 out of 15 up, but only up a teeny-weeny bit. The opposite of the breakdowns, the blue sky breakouts, were up as well. But on Friday, as you know, the market was in trouble. So a couple of things that jump out at me here. First thing is the S&P 500 was down 1.33% on Friday. The HGS 100 was down 2%. The October LLURs were down 3.5%. The IBD 50 was down 4%. The Canaries were down 4.7%. And those stocks and groups moving to the downside were down over 5%. Almost makes you think that you have a really nice tool if we think the market is breaking down of where to look for shorts, and that would be the stocks and groups moving to the downside. In fact, whether Gil knew this or not, Gil uses this list, but boy, that list is impressive for finding things that are not working. Okay, so what else do we know? There was not a Hindenburg signal. You can see the last Hindies were back here on December 17th and December 6th. Remember, the Hindenburg occurs at a top when the pros are selling to the amateurs, us being the amateurs. Most major breakdowns occur after a series of these. Most of 3 out of 4 of these turn out to be a non-issue. So the good news is we haven't had a Hindenburg. You've got to have over 2% new lows, and we have very few new lows, but give it a couple more days, we may get there. Bucketology, you could see that we're sort of back into no man's land, almost a 50-50 split. Now, if you go back, this was on the 4th. If you look just at the 2nd, 2 days earlier, you could see a preponderance of stocks near the upper of their up Bollinger Bands getting to a place of reversion. And this is what it looks like the other way, going back 326, when 17% of the stocks in the S&P 1500 were below the lower band. So we're kind of in the middle, which tells me that there's no reason to expect mean reversion to get us away from going down further. If you look at the market, you could see another shot across the bull's bow with kahunas across the board, except in the NYA and the larger stocks, perhaps. But and it was close. It was minus 0.22% B, if minus 0.24 to get there. You could see we are still stuck in the land of reds and yellows, and very few greens on the Woody indicator, percent B times bandwidth. So I would say this market is, although that's neutral, it's still leaning towards selling off. With Edge Rater, and by the way, the Hindi and bucketology, the markets are all wonderful things that I'm able to do using Edge Rater. And frankly, in the past, I got to do that the hard way, which was manually, using Excel and macros. Not going to spend too much time here, but actually 3 stocks, MSG, MLM, and USAT, actually have pocket pivots, MOBOs, and PSAR reversions, much less than what you normally see. This is a great tool for finding signals. Use this in the George Lee, and I use. If you were at HGSI, you learned about the code blue and the code red. You saw before the stocks moving to the downside. Code blue and code red allow you to look for some of the signals that many of us, including Gil Morales, uses. We look for things with kahunas, pocket pivots, forces, and bongos. And what you're really looking for is the combination of pocket pivots, kahunas, and how many of these blue signals you have. And you could see about 23, 22 to the long side, and when you look at code red, you could see it's a whole lot more of stocks, about 71 had kahunas to the downside, and you could see the large number with downside kahunas, downside pocket pivots, and 4 red signals. So just the feeling that I'm getting is that this is a heavy market, and one that I think probably is rolling over. I hope I'm wrong, because I still have some long positions, but I have protected as many of them as I thought was reasonable with some Mary puts. And the other thing that I feel pretty good about is I've got a bunch of contras. So I'll have to do some scrambling, at least on my contras, if the market gaps open tomorrow. And, you know, from a long side of my brain, that would be okay. I just would be somewhat surprised. I can see the Nikkei opened up down over 1%. And let's see if we see anything in the pre-markets at this point. Now, they opened up a little bit, but that was early, and you could see the early indications are a little bit down, and obviously the word early is apropos. So I also like to look at TradeStation, and when I look at TradeStation, I specifically want to look at a couple of different things, but mostly the elder indicators, and just to get a sense of whether the market is giving me a buy or sell signal. So here's the NASDAQ, and you can see the NASDAQ has taken out the lower envelope. So this is a place that you would typically see a reversal in a good market that like we've been in. And you know, as you go back, it's pretty far. The envelope doesn't come back here in 2010, I think, wherever I am right there. But you know, we ride up along the upper envelope, and it wouldn't shock me to see us ride the lower envelope down some. But we did pierce it. It is red, which is a sell signal. The weekly is red, and the monthly is blue. It'll be interesting to see if this leg down, if it can take out this prior low here, and if it takes out this prior low, will we get a deeper MACD, or will we have a divergence, which might argue for a quicker reversal? If I look at big stocks, the Dow, not nearly as damaged, but you know that already. You can see that we're still got a blue signal, green on the weekly, blue on the monthly. We can see that we're in the value zone, essentially, in the middle, these two lines, the red and the yellow, and right in the middle between the upper and lower envelope. So haven't broken yet on the Dow. On the S&P 500, you could see sort of a mixture. It's red, but it's right in the midst of the envelopes. You know, one thing that might be concerning if you're at all bullish is that you did have a higher high here. This is so your bear trap, or your bull trap rather. And you certainly did not get a higher high either on the histogram or on the MACD line. So clear bearish divergence on the S&P 500 here, blue, and blue on the weekly and monthly. For whatever reason, I don't get the Russell. So let me just check one quick thing here. Let me just take a look at the TF futures. I guess something changed and they charged too much money, so TradeStation took them away from me. You can see the Russell, like the NASDAQ, a red bar. These are futures, so you can see they're already trading. But a red bar down at the lower envelope, red bar on the weekly, and it did not make a new high. It's clearly in a downtrend, lower lows, lower highs. So it'll be interesting to see. So not a lot of happiness, frankly, looking at the markets from a macro index perspective. I look at my radar screen, and for those who haven't been to this before, this is where I live during the day. And I look for pocket pivots. I look for volume and volume, how it compares to normal. I look for red candle highs and green candle lows, ISO failure, which is failure at the 50. I look for stocks that are squeezing. Those have mobile breakouts. I look for Bible gap ups. I look at candlesticks. I have a couple things looking for MACD divergence. These are ARPS's indicators for strength of trends, pullbacks, etc. And then I have what I call my George Lee trigger breakouts. And these include things such as PSAR and squeeze, and it has multiple time frames, looking to see 60-minute, daily, and weekly, how they line up. So basically what I do is I use that radar screen. Now you can't do this in Thinkorswim. Hawkeye is something I'm playing with. I'm not going to comment much on that yet. I'm still trying to figure it out, whether I want to use it in my daily trading. Then I have my indexes, my overnight futures. You can see the dollar is up a few pennies, but really not much on volume yet. I'm sure that's just Scolari out there nibbling. I have my 3X bulls, my 3X bears. Obviously, you see on Friday a lot more green. Now, one thing I'm looking for are pocket pivots on some of these directions. You could see that semis were weak with a pocket pivot on the bear. The S&P 500 was weak with a pocket pivot on the bear. Technology, a pocket pivot on the bear fund. Real estate actually was up, interestingly. I look at the various sectors, and you can see on Friday, and on all of these I'm looking for squeezes, MOBOs, and Bible gap ups, and you could see on the sectors here, only utilities were positive. Then I have a couple stock lists, one that I'm watching, and then this is some that I got collared with puts, which is not correct because I don't have, this is the wrong thing. So these are what I would call my tigers. There's a reason I call them tigers, but I don't need to go into that now. These are the stocks that I'm watching during the day. And there's about 600 leading stocks, and I'm looking for things that tell me what to do. Is it time to jump in, jump out? I'm looking for stocks intraday that have Bible gap ups. I'm looking intraday for pocket pivots. I can look at volume. And you can see, despite it being a tough day, there were quite a few things here that had Bible gap ups. Now, a couple of problems. I had GameStop talk about a failed breakout. It had a Bible gap up, huge volume, and closed down for the day. That probably pretends a bad story for GameStop. In fact, it's one of the ones on my list of potential shorts. Don't know what linear technology does, same story. Micron, I had some Micron. I don't have any Micron anymore. Had decent earnings, huge gap, had a big gap up, even bigger in the pre-market, and it closed down on the day. Myriad had some good news. So the way that I've set these indicators up, the gap percentage is what percentage of 75% of the ATR over 40 days because you need to be 100% of that or 75% of the 40 ATR to count as a gap, big enough gap. So each of these numbers are above that, and this tells you how much above that 75%. The other definition for viable gap up is 150% of the 50-day moving average of volume. So what you're seeing here is telling me that these things, this is a percentage of 150%. So 150 of 150 is really 225%. And you can see that it's more than double here. So I'm looking for these during the day. First, I'll see the gap. I'll see what the volume is during the day and know whether or not I'm going to have one. So I find this to be extremely useful, and I monitor on a bigger monitor where I can see the entire screen at once, a large number of stocks throughout the day looking for potential signals and opportunities. I guess that's enough here. So let's move this out of the way and let's go into HGSI. So I start HGSI in the warehouse view, and let's look at the major market indexes, and let's look at them with a top-down view. So I'm looking at something that's pure price and volume, and one that is looking back 3 weeks or so with a heavier influence on stuff that's right now. So let's find that view. And you can see bad news for the bulls, if you didn't already feel bad. And that is that bonds were the highest performing, as was gold, and then utilities, and then the NYSE and volatility. Small stocks, NASDAQ, semiconductors, NASDAQ 100, the Russells brought up the rear. If you look over a one-day performance, volatility, and then gold, the weakest were the semis, NASDAQ 100, NASDAQ Composite. I think you all know how hard on Friday the NASDAQ 100 fell. If you look at 5 days of trading, transports led. Big loser was volatility, interestingly, which doesn't seem to fit. And I just wonder if we're not about to see a volatility explosion this week as the market rolls over. Other than that, there wasn't a lot of movement except for the high growth stocks that underperformed the market, the IBD 50 type stocks. All right, so you know I like to look here, so let's take a look at a little bit at some of these. We'll start with the S&P 500. I'm going to say this once because everybody who's been here before has heard me say it a lot of times before. I use candlesticks. I have a number of indicators on the top. What you can't, these are Hindenburgs, and the last Hindenburgs were back in December. Then I have the Bongo Weekly. I have the Bongo Daily, accumulation distribution, and then the force, but you won't get anything on an S&P 500 index because there's no volume. I have my high jump bar, red candle highs and green candle lows. I have VI crossovers. I've tried to show viable gap ups here. I have squeezes, and then I have MOBOs up and down. And the price window, I have an 8-day exponential, a 17-day, a 50-day, and a 200-day simple. I've got Bollinger Bands. You can ignore this. It's a 65-day exponential that I've been playing with. Then these dots here at PSAR, let me make a couple quick changes on my view. Let me make these a little thinner. Okay, so they don't take up as much space. And then I want to kill that 65-day moving average. Let's just make it I'm just going to kill it. Oh, I hate doing that. I'm going to leave it because I hate to change my template. So this made the dots were smaller. So you could see S&P 500. Here's the false breakout. This is what's got me a little nervous. We had a new high, closing high on Wednesday. On Thursday, we opened up and traded to a new high on the S&P 500. Even though it's sort of a spinning top, doji-looking day, we had a long tail to the bottom, and we closed inside the bar. So that's because it's a higher high, and a red candle, it's a red candle high. And then we had a second red candle high because we actually traded above early in the day on Friday, and we closed hard down at the 17-day moving average, breaking through the 8-day exponential, a second red closing high, new red candle high. We had a Phoenix on the market, and we had a Kahuna down on this on the S&P 500. So one could be bullish and say you're the upper half of the Bollinger Band, you're still in a major uptrend, and I guess if you're a long-term player, all is good. I'm not a long-term player, and I think all is not good, and I'm very concerned that that is a bull trap and we're going to sell off from here. But we'll have to see what the market shows us, not just what Jeffrey thinks. Because there will be some things I'm going to show you today that are not as weak appearing. The Dow Jones Utility Industrial Average, which is right in front of my face. Sometimes it's hard to see something that are right in front of you. You ever notice that? Similar pattern, except it's now been in a weekly bongo red for some time. Daily forces turn red. Red candle high on Friday. Kahuna and a Phoenix. Similar pattern S&P 500, worrisome. If I look at the NASDAQ, a little different, much more worrisome. Everything's red here on the technicals. Mobile breakout to the downside. Pocket pivot to the downside. This is a pocket pivot to the upside, the blue. A Phoenix, a Kahuna, and we are at the lower end of the Bollinger Band with a PSAR sell signal. This is the weakest of the indices. If I look at the Russell 2000, it might be comparable. Let's see. Not quite. It's got a green PSAR, but it'll take it out very early tomorrow if the market sells off at all. Mobile breakout from the squeeze, weekly bongo to the red side. The weekly bongo red is a sell signal if you're a type 4. And it's something that's very concerning. It's late to fire, which is why I cheat and I have a early weekly, which I'm trying not to confuse anybody with today. But that being red is a very worrisome sign. If we look at what's working, let's take a look at, first we'll start with volatility. Now, I'm actually happy the volatility was pretty low, or is pretty low right now, because it made my married puts or protected puts extremely cheap. I was able to buy deep in the money puts with almost no time premium, just paying the intrinsic value between the price of the put and the current price of the stock. And because the volatility is low, the price on my puts was quite affordable, and I couldn't resist. Makes me feel pretty good whether the market goes up or down tomorrow, and then I'll play around on my shorter term positions and not have to worry as much about my long term. As I said, I can generate premium against those positions. What that protected put has done is it's going to mute my upside until I take out the put price. But it's for the price of the premium, it's guaranteed that I'm not going to lose any money on the stock. And the only thing that's really at risk of losing is the time value, which would be that part of the premium greater than the strike price minus the stock price. So it's silly in a bull market to give away part of your upside, and that's what I've done. But in this market, I've locked in my downside, and because of the way I'm going to sell premium around those puts and the shares of the stock, I'm going to actually, I'll make money on the position with no downside risk, lock in my gains, and not have to pay capital gains until next year on them if I hold it this way. And there's a reason I've taken so many capital gains. I'm trying to spread that out. But we shall see. I've done different things in the past. The married puts that are deep in the money is a different strategy that was recently pointed out to me, so we'll see how that goes. Bottom line is, it's protection, but like healthcare insurance and life insurance, I'm paying a piece of my money for that. Volatility is down low here, continues down low, and again, that's why my puts were pretty cheap. It's been whack-a-mole time. Every time it's popped its head up, it's gotten whacked. If this market rolls over, we're going to go back and test the 20s, and potentially it wouldn't shock me to see us go even higher in the volatility. I'm sorry, I need to knock that off going forward. And as George Lee has taught us, it's those periods of rising VIX when the market is tough to make money on the long side. And this VIX is kind of low considering what I feel like in my stomach from watching the market this week. So part of the mixed signals is that low VIX is complacency, and maybe I'm wrong, and maybe there isn't a big rollover coming in the market. We look at the gold. Showed some life last week, got back above the 200, still in a PSAR sell signal. The Phoenix here is on the market, not on gold. You can see the Bongo Weekly has stayed green ever since it broke up here. And it also got above the 8, so perhaps early evidence of a revival in gold. How about silver? Not quite as pretty, sort of all over the place, and still below the 200-day moving average. And lastly, we'll take a look at the dollar. And the dollar starting to move up. Now, you know, I try to sort out all the different influences that could be affecting the market and my money and your money. And the fact that we're starting theoretically to tighten here, and by tighten I mean we're talking about taking out additional bond purchases. So it's still loose, but not as loose as before. And now you have Draghi, or whatever his name is, over in Europe, talking about extreme steps and measures of more loosening, negative interest rates, bond buybacks, etc. If we're getting tighter and the rest of the world is getting looser, that tells me our dollar goes up, which means we have a harder time selling things overseas because we're too expensive. And that may hurt our economy, and that could also hurt our stock market. So we might want to watch and see that. And although it wasn't talked about much on TV on Friday because it was more about the apathetic jobs number, perhaps the rising dollar is part of the concern about our market, although you can see here that the dollar actually traded down on Friday, probably related to our jobs number. Now, because there's no volume on some of these, I like going to the broad market indices group. These are calculated based on the stocks, and I like looking at the S&P 1500. So the purpose here is it's broad spectrum. It's 500 to 600 to 400. So the 500 is big, 600 is small, and the 400 is mid. And I could see that similar to what we saw in the NASDAQ, it's weak, although not as weak as the smaller stocks only. Still above the 50, but knifed through the 17 in the day-to-day exponential moving average. A kahuna to the downside, still green on the Bongo Weekly. The forces are red. And what I really like is I can go into some of Ian's charts, which he calls, and we all call the eye charts. Just get an idea of what's going on in the market. So here's a clean chart that shows the sell-off that we saw on Friday. It shows us Bongo Weekly is green, the rest are red. And it shows us that the green on the DI net plus is about to cross under the negative, the DI negative. Okay. We look at accumulation distribution. We see here that the A's are coming down, the E's are going up, and the C's are the leader, but both the A's, the E's and the D's have turned up, while the B's and the A's have turned down, so that's a little worrisome. If I look at 5-to-1 days, we had a 5-to-1 day to the downside. So this is looking at 5-to-1 advances decliners and advanced declining volume on the S&P 1500. not something that you see at a time of strength. And then lastly, if we look at a number of shares above the 20, 30, 50, and 200-day moving average, let's take a look at this. So we have Bollinger Bands here on the SP 1500, and we can see that most of the stocks are still above the S&P 50. And all that tells me is that they've broken below the 20, they've broken below the 30 on the simple moving average. They're still above their 50, and they're at about their 200, which means there's plenty of room for them to drop. So I would put all this information as confirming that the stock market is weak. Next part of top-down investing is to actually go in and take a look at the industry groups. And if we go to the first one, looking at very short-term movement, you can see not a whole lot of groups are making my list. Now, I'm going to make sure I got the right thing here because I thought I saw more groups. Must have changed when I did my last update. And a couple things here should tell you about why your portfolio might be feeling pain. Not only are there only 9 groups to the upside, but you've got all defensive. You got gold, you got utilities, and you got REITs and closed-end bond funds. Not what you'd expect to see in a strong market. Forced to the downside, a couple of our old friends are here. Automobile manufacturers, Tesla breaking down. Drug retailers, regional banks, airlines, oil exploration, apparel and retail, trucking, insurers, steel, paper, finance, storage and transportation index, home building, coal and consumable fuels to the downside. Let's take a quick look at some of these upside groups, see if there's anything interesting on gold. Look at the first 3 or 4, see if there's anything that's given us anything that says it might be something to consider buying. Let's go to my nuclear scan chart. So we have Gold Corp below the 200-day moving average, PSAR sell signal, nothing too exciting. I think at some point you might want to be thinking about these. If gold heads back up, it'll break above the 200. If that happens, that might be an interesting time. Barrick Gold is above the 200, so that's a little bit more attractive. It might take out its PSAR if it moves up at all tomorrow. They have a mobile breakout on Friday, but it's 2 below the 50. These have been in deep downtrends. El Dorado, even less exciting. Royal Gold, probably the best of the bunch in that it's pulled back to the 50, and it's going to move off from there, which means there's a lot less of this overhead supply and more of a clear blue sky for it to take off once it gets beyond the 17. So they're all beaten up. This is probably the least beaten up looking at those charts. Next one in the top 10 are electric utilities. It's hard for me to get excited about this group. Just show you what's perhaps exciting here. First of all, they've been a nice uptrend. Here's pocket pivot. Everything is green. And I think what people would like about this stock would be 3.6% dividend. Entergy, 4.8% dividend. All these are the same uptrend. Remember this thing here, the Phoenix is on the NYSE or now it's on the NASDAQ, either one of those, whichever I picked, and not on the individual instrument. Southern Company, little pullback to the 17, a pocket pivot on Friday, mobile breakout from the squeeze, 4.6% dividend. NRG Yield, nice shallow saucer, almost a handle, taking off here, everything is green, 3.1. So the message here is yield and risk. So not good for growth stock investors. Independent Power, NRG, just take a look at 2 of these, see if they look any different than the last did on both fronts. So on the dividend front, it pays 1.5%. Looks very similar to what we were seeing in a nice uptrend. So as the market's gotten ugly over the last 2 months, utilities have quietly, not that quietly because they're the leading group in March, have moved to leadership, which isn't saying a lot for this bull market. One of the things that's different this time than the majority of the corrections that we've lived through over the last 14 or 15 months is that there has been a big move, as you see here with this force index, of stocks to the defensive side. AES, shooting star there in a pocket pivot, that's kind of ugly, 1.4% dividend. So nothing too exciting there. Let's go to the next one, precious metals and minerals. Sort of junk off the bottom. Stillwater, it's a lot like the gold stocks in that so actually, I take that back. This was one that looks actually good. Took out its PSAR, went to a PSAR buy signal on Friday. Everything is green. This one is in an uptrend, so I take that back. This one looks quite good. Here, pull back to the 50. So the silver stocks look better than the silver itself because the silver itself is living less than the 200. Sandstorm gold. This looks like the gold index coming back off to 200 in a PSAR to the downside. So those are precious metals. Again, these are all very defensive plays when the market is selling off. More utilities. I'm not going to spend a whole lot of time here except show you the same story that I've showed you, which is they probably pay dividends and they're probably in an uptrend. So pull back to the 50, moving up. Everything is green. And this is Pacific Electric and Gas, and it pays a 4.1%. Next one is PEG, uptrend, pocket pivots on Friday, 3.8%. Consolidated Edison in New York, in the midst of a deep pullback, still well below the 200, I'd pass 4.6% dividend. So I think you get the message. Construction materials, these are interesting. There's some good news, I think, on financing for Cemex. I don't think it was a buyout, although I could be wrong. You can see it was up 5% on Friday, and it brought its list up. So this is a Mexican cement maker, if I remember correctly. Well, maybe it's not just Mexican. It's the largest cement company in the world. Trades on the NYSE. Now, you know, it's an uptrend. Pull back to the 50, big kahuna, everything's green, out of a squeeze, breaking out. Got to love the chart. Does not pay a dividend. Do your research, has a negative ROE. There was some bad stuff. I think they settled a lawsuit or fine. It was much lower than expected, I think was the news. Let's look at this on a weekly. I think this is a stock that's come from the single digits, but it's been going sideways really for a year and breaking out now. That might be something interesting, and I'm sure that considering the fact that the stock trades 14 million shares a day, that it was a big part of leading this group to the upside. Martin Marietta Materials, more construction materials, sort of pulled back to the 17, had a pocket pivot on an up day on Friday. Here's another cement maker. Big shooting star, that would worry me. Good earnings per share growth. This is Eagle Materials, pays a dinky little dividend, paid at a big multiple of 37. A lot of people that I've heard are talking about a bubble in this type of stock, so I'd be careful here, although that CMEX story might be something you need to learn about. Then we get a couple of REITs, and I'm not a big REIT person. So I'm not going to spend much time trying to pretend that I know what I'm doing on these, except I can tell you that uptrend, mostly green here, in a squeeze, and it pays 2.8%. That's Essex. Avalon Bays pays 3.5%. American Campus pays 3.8%. And like the utilities, I think these guys are up here because of their dividend, safety play, in a time of tough market. Closed-end funds. Whoops, I'm sorry. I have to remember you need to highlight these things before you right-click. So highlight closed-end funds. A lot of muni bond funds here. So, and most of them are relatively short duration bond funds. 16 up to 19, mobile breakout, big update, percentage-wise, well, not percentage-wise, it looks like a big update, but it's not. On Friday, BlackRock, Stone Harbor, doesn't look that exciting. A couple of these had good yields. Here's Nuveen intermediate duration, pull back to the 50, 2 kahunas in a row. So I want a big yield. Here's one, Nuveen Insured Muni Opportunity Fund. Don't know anything about this, so I'm just talking. Mobile breakout from a squeeze. 13-day force is red, which is kind of interesting because it really looks like it's going sideways. It pays a 6.4% dividend. Close-end, diversified, current income exempt from regular federal income tax, enhanced portfolio value. You know, I'm retired. I like the fact that it's tax-free. I like the fact I'm buying closer to the bottom than the top. This is a weekly, all green on a weekly, coming out of the mobile breakout squeeze on the weekly. And I love the fact that it pays a tax-free dividend of 6.4%. Now, I don't know much about these either, except it's an intriguing little story. But I think the story is flight to safety, flight to safety. Office REITs, Boston Properties shows up all the time when I look. And what you see, a nice uptrend here, everything is green, it pays 2.2%. This is very defensive, different this time, and suggests that the market is different this time. Go to the force index down. And you, again, I'm not going to, essence of time, I'm not going to go through all of these, but you could see there's a lot of groups to the downside. Some of these have been leaders. You could see that many of them have 13-day forces are green, which means they've been an uptrend. One thing that seems to get people interested, something I used to do in the old days, just going back to my trade station for a second, was to look at the commitment of traders report on the S&P 500, here's S&P futures. And what I pointed out was that you can't see it well, but in these, the royal blue was the professional investors. These are the commercial hedgers. We don't really worry much about them. And these are us. And that as the market came down in 2007 and 8, what we had here was the individual investors were buying the whole way down, and the commercial guys came in right before a bottom, and the commercial guys, the professional investors, not the hedgers, the professional investors, they were buying the market all the way up while us individual guys were selling. Well, what we see here over on the far right edge is we are buying, and they were selling. Now, it almost looks like that's reverted, but it doesn't look like a whole lot yet, so we have to watch and see what happens. But what this tells me is that individual investors have finally decided it's time to jump onto the market, which might mean it's time for everybody else to jump off. A couple of things I like to do before I say goodbye is maybe we'll look at some stocks to short and see if there's anything that looks good. Other things that I typically do, which for the essence of time I don't really want to do right now, I usually do a group inclusion report, and we'll look at those stocks before we say goodbye. I also like to look at various views. One of the views that I might be looking at right now would be my Sprinter view, which is actually Ghilardi. So we'll go up here to Dave Ghilardi, pick Sprinters, and you can see how low that number is, but often the best of the best will be in this group. Now, if you look over to the right, you can see auto parts and equipment. Now, they look, there's a ton of them. In fact, here's another one. Let me do this fully. So you've got 1, 2, 3, you got 6 auto parts and trucking auto parts and equipment stocks making it to the top of the list. Delphi, which should be in that as well, and Federal Signal come out as construction and farm machinery. So you have a ton of auto parts and equipment. You've got trucks. You've got specialty chemicals. I don't see a lot of finance. I don't see a lot of oil exploration. I don't see, I mean, just think what's not there technology-wise. Just tells you this has been market rotation. Now, despite the fact that we have all those auto parts, I don't think they look that good, to be honest. Let's just quickly look at what we see here in the sprinters. Now I'm going to go very quick and say what I think and move on. USA Truck, no earnings growth, although it's a turnaround. It used to lose money, now it's breaking even. Shallow saucer going back to 2013 November. Looks like it's breaking out now. 3 kahunas in the last 4 days, mostly green except for the Bongo Weekly. I actually find that one kind of being intriguing. I would do some research on it. I like the chart pattern. And notice my short Bongo Weeklies actually turned green as well. Now this is when I would, if I had more time, which I don't really think I have tonight, it's gone on a long time, I go to USAK. And I look at it in my MarketSmith. You can see that nice sideways. You know, this is interesting. It means leaderboard's looking at it. 67 cents in 2015 and 150% grower, 26 this year. It's a turnaround stock, and let me see what the weekly looks like. And you can see MarketSmith has put a target of about $20 on this stock. So this might be one to look at if the market holds up. A lot of truckers made the list. They don't look at this. I don't know, Wayside Technology Group, nice run up. A little bit of a bull flag here. Powerful group move. Everything is green. Again, not much in the way of earnings. Eagle Materials we already looked at. Visteon is very typical of these automobile parts companies. Pretty much lower left, upper right. Sort of had a red candle, had a red candle high Friday. Very close to the top of its high jump bar. An extended stock, good run. Don't like the earnings going forward. Looks tired. Magna, same chart pattern. Tower, same chart pattern. Gentherm, same chart pattern. So auto parts have had a nice run. They all seem to be getting tired here. Maybe they all turn around and move up together. I'm a little nervous about that chart pattern. China Automotive, similar, not as pretty as the others. Here's Minerals Technology, MTX. Don't know anything about them except to say that it had a pretty ugly day on Friday, although it's been all green. Look at this bearish engulfing pattern, but still closed above the 8-day exponential, so it's not all over yet. Here's a trucker rider, just looks like those automobile parts rolling over. There were a lot of oil tankers that looked interesting. I don't know this one at all. That's a refiner, that's why it's not a tanker. Pipelines except natural gas. Probably pays a bit of a dividend, 2.4%. Nice roll up. Doji at the top, looks like it's rolling over. Gas log, this was a big mover, had a couple bad days, Thursday and Friday, a leader. I wouldn't get into this until it goes back in. It certainly takes out Friday's high, if not Thursday's high. Everything's green, great earnings per share growth. When this market turns around, or if it bounces right away, this might be one to watch. Federal Signal, looks like the auto parts, bearish engulfing pattern. Build-A-Bear Workshop, I don't really understand this company, but everything is green, red candle high. You know, it looks as good as anything else. It's still got a PSCR green signal. Traded above the doji, but really didn't do much on Friday at all, although traded up a little bit on a very weak tape. Build-A-Bear. Martin Transportation, is this trucking? Trucking, looks like it's rolling over. Shiloh Industries, not too exciting. Arkansas Best, another truck rolling over. I think you get the gist, is that even the sprinters over the last couple of days don't look attractive, and it's what's missing here from industry and sector that maybe is the loudest story. On the group inclusion filter that I ran earlier today, 29 stocks. Let's quickly take a look at some of these. Let's look at industries, oil, gas exploration, so the fact that they were not on the force down means there's some weakness in the group, but I saw some patterns that I liked. I mentioned the auto parts and equipment were leaders as well. So this is a list from a mechanical list from the group inclusion filter. A lot of the same stocks that are sprinters. It means they made it to a lot of bull lists. It doesn't mean they're at buy points. Just very quickly go through them. Synnex Corporation, one of the better charts out there. Bible Gap up, everything is green. Kahuna as well, had a Kahuna on Wednesday, didn't do much on Thursday. This is in the technology distribution, whatever supply chain for IT. Bible Gap up rules at play. You're about midway point. You know where your stop goes. You might want to take a look at something like this if the market trades up tomorrow. Eagle Materials we already looked at. Matador Resources, sort of based up here, it looks like it wants to run again, although it had a closed down on Friday, a little bit, down less than 1%. Continental Resources, I think this is one of the stocks on our LLUR list. At a top, perhaps that'll be a reversal day, remains to be seen. NRG Energy, a utility with a dividend. Hilltop Holdings, I believe this is a bank holding company. State commercial banks, really been basing for quite some time, had a bunch of pocket pivots this week. Not that great, but I guess in a sea of bad things it stood out. Sorry, going the wrong way. No dividend. Spirit Airlines, I think airlines, all of them look a little rough right now. They all sold off some Thursday and Friday. If the economy is slowing down, you would think going into the summer that it's a busy season for them, but they're showing some weakness, and the majority of these stocks, and I think Spirit included, had just huge run-ups over the last year. Spirit from less than 20 to 60 since March of 2013, so maybe they're due a breather. AFOP has reaffirmed earnings. Let's hope gap up on Wednesday, went sideways the rest of the week, traded down 3.7% on a week tape on Friday. Tower International, another automobile parts, you can see it's got a bearish engulfing like the rest. Gas log we looked at. Methanex, pulled back to support, big hammer on the 50. Now it's got a buy signal on the PSAR. But the bongos are weak. Force 2 days still negative. Great earnings per share growth. I'm a little worried about this. I'm not sure I'd be jumping into that. Michael Kors, a leader, which has rolled over, 2 pocket pivots down. Everything is red. Will it go down to 80? Who knows? Maybe it bounces from here. Questcor, bearish engulfing pattern on Friday. I don't even remember hearing bad news about it. I guess this is one of the last biotechs and drug companies that haven't been clobbered yet. So that's obviously very weak. Federal Signal, automobile manufactured parts, motor vehicles and passenger car bodies. Bearish engulfing on Friday. Magna, bearish engulfing on Friday. Here's an energy stock. Looks like it tried to break out and then it just died on Thursday and Friday. United Rentals, this is one of my long-term holdings, one with a married put on, and you could see, since I bought my puts, it's traded down a little bit. PSAR is green, but it's sort of a big bearish engulfing candle on Friday. Tagco of America have had a beautiful run-up, which you really can't see here. Now you can. And now it's getting kind of junky here. It doesn't look that bad on the weekly. It looks like it's in a retracement and then in a bounce. It's above the 8-day exponential, but it looks like it's stuttering here. Too slow. Holysys Automation, another this electronic equipment. Again, some things to like here. It's an uptrend, sort of pullback, mostly green here, pocket pivot, but just a big long-legged doji on Friday after a bearish engulfing candle on Thursday. If this opens up, it might be interesting. Almost done with this. Emerge Energy Services, it's got to be a dividend play, 5.5% dividend on oil field services, breaking out to a new high, nice dividend there. I bet it's lightly traded, let's see. Yeah, only 172,000 shares, not enough for me to be interested. Gentherm Automobile Parts rolled over Thursday and Friday after hitting a high on Wednesday. EOG, oil exploration company that is in our LOUR, or was one of the candidates. Tough day on Friday, but up to that looked pretty good. United Insurance Holdings going sideways. PSAR sell rolling over, tuning to the downside. These stocks don't look so great. Southwestern Energy will look a lot like EOG and CLR. Rough day on Friday, but in a nice uptrend. Myriad had some good reimbursement news. Pull back to the 50. You had your Kahuna off the 50 here. Actually, Kahuna and a Bible gap up on this day, Wednesday. Traded up Thursday, and even though it's a red candle, closed higher on Friday than it did on Thursday. So technically an up day, despite the fact it sold off intraday. Very bullish in a tape of sea of ugliness. Everything is green. It was driven by higher Medicare reimbursement. Air lease, so in the base up here, will it base to take off or will it break down? Time will tell. Last 2 days were ugly. Caesarstone, I think this is an Israeli granite company. And it has been in a nice uptrend. And it's pulling back to the 17 weekly, which would be like, actually you can see here, PSAR buy signal here, but ugly day Thursday and Friday. Align Technology, red candle, but it closed higher than it did the prior day. So a breakout, Bible gap up from the squeeze, a Kahuna. You don't like it when they close in the lower part of the candle, but this was a horrible tape. Makes money. Healthcare supplies, no dividend. Might be one to take a look at. Just in the weekly, I think it was in an uptrend. Uptrend, pull back to support, and a big day on Friday. So something to consider there. Looks good. Quihu, it's broken. All right, so what I really want to do real quickly now is to show you what my buys, potential buys look like, and they don't look good. And then some ones I thought about shorting, and then I'm going to say goodnight from this marathon call. I really don't love these stocks. To say they're the best or the worst, a couple stood out to me. Ultra Petroleum, probably my favorite in the oil exploration and production. Big uptrend, multiple pocket pivots, in a tough tape on Friday, gapped up and closed up for the day at an all-time high. So this on a weekly. Actually, it's not an all-time high. It is a multi-year high. We're going back to 2011. So it's going to have some resistance potentially at this 200-day moving average. You can see the group strength, and it's one of my holdings. I'm glad I looked back at that. I might be wanting to take my profits on this one sooner than later. Many of these we looked at before. Best Buy is sort of bottom fishing. Pocket pivot and a Kahuna on Friday, a little bit of a gap up out of the squeeze. Mostly green except for the weekly bongo, which is going to take a while, but the short weekly bongo did flip. So it makes me a little bit more optimistic. Short weekly bongo is just a 3-day version instead of 5 days. So I thought that was interesting looking. I don't have to go long anything, neither do you on Friday. On Monday, it's really an ugly market. Another one that looks like a bottom fish opportunity. And why would I even think about this? Because it's going to bounce off this 50 and go down. Because it might not. Still red on the weekly, but had a pocket pivot, a mobile breakout, and I think this pays a dividend too. Pays an 11%. There it is. I knew there was a reason why I was interested here. Pays an 11% dividend. It's got 13 million shares are short. You know, it's junk off the bottom, but I love that dividend. And if it trades above that 50, comes back, retests the 50, and it holds, you might have a run up to $41, and you have a huge dividend when it gets paid. That was why I like Seadrill, and God only knows what to do with this, but coffee looks like it's making a recovery. It had a pullback from 42 to 34. I'm just curious. I don't usually do Fibonacci retracements, but what the heck. So son of a gun. It pulled exactly, don't you love it when things work like this? Pulled exactly to the 38.2% retracement, and it's running again. So Joe, an ETF for coffee, if you're so inclined. It's kind of interesting. On the sell side, boy, I could have had thousands. And I mean, I look at a couple of what might be my favorites. There's a lot of stocks out there. Many of them are too late to short. I'll point to some of my favorites. Again, many of these are too late. Amazon.com. Too late or not too late? Broke below the 200. Where's this thing going to stop? The market turns around, it gets a bounce, this probably goes up very fast, but it's now taking out its weekly 50. Could this run down at $250 or $260? Why not? If the market goes out and gets trashed, some of the biggest leaders are the ones that are going to fall the hardest. This is on my short watch list. Again, a lot depends, I think, on what the market does. Acadia Pharmaceuticals, also on the weekly, breaking down to the 50. Now, I would argue that these are all late, and I would have been better off shorting them up higher. But, you know, there once was a time when stocks actually stayed below the 200-day moving average for a while, and these stocks have not dropped below the 200-day moving average in 18 months. This is the first time there. Cardinal Health, my old employer. I think this is really ugly. A bearish engulfing pattern. Everything's turned red. Red on the weekly bongo. Red kahuna down. And knifing through the 8, the 17 to 50 all on Friday. Stopped at the 65 for whatever that means on the exponential. I'm a little worried about Cardinal Health here. It pays a teeny dividend of 1.8%. Haven't worked there in over a year. I know no inside information. I just know that this whole group, McKesson, Cardinal, and ABC, have all done this, 39 to 69 in 14 months. You don't last like this forever. You haven't had a big pullback in this group. And if you look at McKesson or ABC, you're probably going to see the same pattern. Is that a shorting candidate? Why not? Down to the 60, that's 10. Who knows? Athena Health, probably too late. It'll probably bounce off, but if it retraces up to the 50 with a rally, why not? It makes hardly no money. It gets a huge premium in the market. It's had a ridiculous run up. At what point do you say enough and it's going to short? Well, this up here. But like I said, if it retraces back up to the 50-day moving average, it might be giving you a shorting opportunity. LinkedIn, well, this has been a continually shorting opportunity. Every time it got up to this 50-day moving average, it's a little bit too far down now. This is a bingo. I might look for a real recovery over the next few days. I wouldn't touch that for a short until it trades back up to the 50. Zillow, what the heck is this stock $92 for? It doesn't make money. Its revenue sucks. You know, it hasn't rolled over yet on the Bongo Weekly. It did have a pocket pivot, I guess, sort of kind of on Friday, but it didn't do much. When does this come down? You know, it's had a huge run on an IPO since August of 11, and it doesn't make any money. I don't get this company, but weak tape, market rolls over. You don't think this is falling? NetScout. Ran up to the 50 in a strong market, they bounce off the 50. I got a red on the down weekly bond go down. Does this have an opportunity to run back down towards that 200-day moving average? I think so. The nice thing about this is I can set my stop probably right at the high of that bar or even right above the 50-day moving average. And if the market goes north, I get taken out of my stop right away. But NetScout looks interesting. Many of these, I admit, are late. Home away, too late, probably. God, I hate this company. Every time I buy it at the wrong time. Does it bounce? Maybe. Or does it break down further? Does it go down to 20 or 21? It's not like it makes a ton of money. Fair market, these high PE, high beta stocks get taken out to the woodshed and shot. Electronics for imaging. This is a 3D printing stock. It doesn't say that, but they make printers, including 3D printers. And you know what's happened to 3D printer companies? Everything is red here. It breaks below this 50. I think this one pulls back substantially at a kahuna to the downside. It's not that far off its high that it's too late to consider shorting. GameStop. Could it be any prettier? It failed right below at the 200. Yeah, you should have shorted it when it had viable gap up, failed on Friday. But probably not too late to short. I mean, the list goes on and on and on. Priceline could have had a big move already. Does it trade all the way down to the 200? Unless this market turns around quickly, why won't it? Of course it will. So I think you've got a lot of shorting opportunities. Some that I didn't show you. One because this hurts too much. Just kidding. My old friend Celgene. You know, the short was up here at 170. The short was here at 160. Maybe we get a retracement back up to the 200 or the 50 and you short it again. Gil Morales called that one right. Alexion, you know, it's already had a big fall, but it's an expensive biotech stock, a big multiple of 51. Does it continue to fall? I mean, look at something like Celdex. This was a darling, and it's just hammered. How much further is this going to fall? I heard somebody say today 6. He was joking, but maybe 9 isn't a joke. Not sure I would short this one. Messages, there's a lot of things out there that look bad. So let me show you one last thing. I started by showing you the performance of stocks and groups to the downside. If this market rolls over, it's a big 2-letter word, you might want to go to Woodward and Brown, stocks and groups to the downside, and a lot of the ones that we just looked at are right in this list. And this might be where you're going to find the next group of stocks to short. Because I was totally, I guess I could say amazed, maybe I should say impressed, and maybe no one's even left to listen to me. I'm going to go back to the week that was. I'm opening up my little fancy spreadsheet. I'm going to go back to the week, the whole week, Friday to Friday, 7% down, 88 and 98% of the stocks dropping. This is a great list to start worrying, to find your shorts. This is a great list to find your shorts. And they were down the entire week, not just on Friday. On that note, let me just go back to my PowerPoint real quick. As always, thank you for spending your Sundays or whenever you listen to this with me. Those who've been around know that I really am historically kind of an obnoxious perma-bull. And if I'm taking this bearish of a stance, then either I'm very wrong because I'm not used to being bearish, which is certainly possible. We've got a market that is in serious damage. So I just want to go back to here and review this. So contact me if you're interested. I'm working on 3 different hotels. I should have an answer by midweek. Once I determine which hotel and the degree of meals that I'm going to provide, I will come back with a price. I don't do these to get rich. I already have enough money. I do these because I like to give back, and I enjoy teaching. But I don't do them to lose money either. I lost money in New York. There's a local expert who I'll try and engage, as well as somebody who's a seasonality person on the other side of the state. I'll try to have him come over as well. But for now, it'll be just me. This is the weekend following Father's Day, a week later. West Palm is a beautiful place. Two of the hotels are on the island that I live, right on the ocean. One of them is by the airport, and I'll make a decision in the next couple of days. The airport hotel has got awesome internet speed. That's why I like that one. Love to see you here. I'll be a small group, and you better go home being an HGSI whiz, or I didn't do my job. I know George from HGSI will be here as well. Thanks everybody, and good night.